You know, this is a good classroom experience for all your viewers out there that aren't real familiar with auctions. It went very well. We just auctioned off $39 billion, 10 years, technically 9-year, 11 months. We're adding to an issue that was already open. The yield at this auction, 4.235. The when issued market was about 2 basis points higher. Okay, so lower yield, higher price means that the government sold it better. Okay, very solid. So it was good yield at the auction, and the bid to cover 2.70, Kelly, was the best since April of 2016. All the metrics were above average. The one that was below is a good thing because the dealer takedown at 10.5% versus a 10 auction average of 15% means the buffet table was cleaned up by investors, leaving a small amount, the smallest amount, well, since September of this year, but it was solid. So I give this auction an A. But what's fascinating is many times I give a weak grade, and you see yields move a lot. Yields haven't moved hardly at all since the auction ended, as you showed that intraday chart. And the lesson that teaches me is that you can't always judge an auction by the immediate reaction in the market. It was a great auction, but the issue is CPI was a bit warm, and I think that the fact that yields really didn't move much on that number, but they're not moving on a good auction, tells me long-dated yields are going to remain stubborn as long as inflation remains stubborn. And I think that's the lesson to learn today. Tomorrow we complete the auction process with $22 billion, 30-year bonds. Back to you.
Rick, why do you think the market is so dovish about a cut this month, about 3 or 4 cuts next year still?
Well, I think it's dovish because it knows it's going to get them. The Fed is going to give the market what it's pricing in. However, I do think that the equities could look at all of this data in so many different ways. One way is the reason we're not getting more cuts is maybe the economy's horsepower is holding up better than expected. But while all that may be true, inflation's holding up as well, and I think that's going to be the issue that drives the difference between short rates and long rates.